And we're really excited today to have Matthew with us. Many of you have heard him speak before. He's our market analyst and he lives out in Los Angeles, so we flew in to give this presentation, and I'm grateful for all of you coming and taking the time to hear what he has to say. And I just wanted to introduce John. Most of you guys know him, and so here he is.
Hope you know. Well, how many of you have been here for one of Matthew's presentations? Good. Okay. So I met Matthew a while back, and just to me, he was far different than most anybody I've met in this business. Going back to the kind of person he was. Plus, he has a tremendous amount of expertise. And we worked together for a good year or so now and got some models down to do what we wanted to do. But I really didn't have enough. Although I had him on a contract basis, I wasn't comfortable not having more of his expertise and time for us. So I'm very proud to announce that we're now writing a very big check to Matthew every 2 weeks. He's a full-time employee of our firm. So when we do this, Matthew is the type of person that doesn't do something for a dollar, but I want to give him I want him to feel some of what I feel. So the way his compensation is based, he has a nice salary, but he gets a bonus, a nice bonus. Not if you make money, but if you make money at excess return. Now, how to explain that just goes to say that if you get a greater amount of return than the risk you took, that's excess return, and then it goes back the opposite direction too. If you don't do as well, then he doesn't make a bonus or a bunch of bonus out of the way. So I'm very, very proud to bring him on. Long time ago, I learned that as I work for you, making money is not enough. How many would agree with that? Not enough. Because if you don't know you have enough and you do, you kind of don't, right? So the purpose of these classes with Matthew is to teach you more, but I want to give you an idea of what I want you to learn. Imagine that you wake up in the morning and you're driving down the interstate in a car at 50 miles an hour, but you've never seen a car, never been in a car. But you're traveling 50 miles an hour in this car. How would you feel?
Scared.
Scared? You don't know what the steering wheel does, you have no idea what the brake does, the shift, all those things. But the problem's not with the car, is it? There's really not a problem with the car. You just don't understand the car. So we're trying to kind of teach you how this works. We do some things a little bit different than some. I read in the paper this past week that American funds, big, very successful fund family, after 16 years of bad returns, is now looking to incorporate tactical management into portfolios, the very thing we're doing. So what I hope you take away from this presentation, and I don't mean for you to go so far down that you know how to work on the engine of the car, how to change the oil, or what the timing belt does, but I want you to understand how your car works. Have I kind of made that clear? So without any further ado, let Matthew Inouye come in.
Well, hey, how y'all doing? Terrific. Good. Well, it's been a while, and I'll say, do you guys have this kind of weather all the time, or it seems like last time was this cold too? All right, so let's get started here. All right, so one of the exciting things about me being, folded into the whole firm is that we can now offer investment strategies and different sort of solutions to different financial needs. And that's really where all of this comes together. My background, for those of you who have not been here before, I'm an electrical engineer by schooling. Lots of numbers, lots of stats. But I've always been interested in the stock market. I've been an equity trader for over 15 years. My dad got me buying stocks when I was in 5th grade. Mead Company, Mead Paper was the first stock I bought. So this has always been a passion of mine, and I've sort of parlayed both of these things into becoming a coach at a company called Market Smith. Now, some of you may not know Market Smith, but you know the sister company Investors Business Daily. William O'Neill, he wrote the book How to Make Money in Stocks. Basically, I teach people how to use data, how to use technology to pick better stocks for their personal investments. So that's kind of my background, and now I'm very pleased to be working with John and trying to come up with some good solutions for you folks. Okay, so the real whole premise of today's presentation is going to be about thinking differently. Okay, because that's what we're doing at JCN is we're trying to develop solutions that are different than what everybody else is doing out there. Okay? When we think about what the current investment advisor might do or suggest, they may say, well, you know, you're looking about 70 years old, you're about ready to retire, maybe you are retired. You should have maybe 70% bonds, 30% stocks. And out of all of that, you should have a mix of, you know, some international stocks, some dividend-paying stocks, maybe some REITs, maybe some large cap growth, and they basically just spread everything out, right? So what they're trying to do is they're trying to reduce the risk by just spreading everything out. They're not really focusing on a strategy per se. So we'll go through this and talk about what it means to think differently and how we're approaching this. So let's talk about the whole cycle of mediocrity. And this, you can relate this to any part of your life, you know, relationships, career, investments. But when you look across the board and you say, well, what is everybody else doing? I think I'm going to do it too. Already we set ourselves up for sort of just, we're not going to outperform everybody, we're not going to underperform everybody else, we're just going to kind of stay the middle ground, and we can't really truly achieve success, right? A lot of times people just settle because, well, if I didn't get the kind of market returns that I was looking for, everybody else did about the same, so I'm happy, I guess. What we're trying to do here is we're trying to break this mediocrity cycle, and we say, let's look at this from what a success cycle looks like. And success to me, the way that we really make progress, at least in the engineering world, is we observe a situation, we question, well, why is it this way? Then we come up with an idea and we say, how can we make it better, right? Then what an engineer does at that standpoint is he takes the data, he tests it, he tries to formulate new solutions, and he comes up with a result, but that's not where the engineer stops. Right? The engineer will go out and say, well, now that we've got a result we want, how can we improve it a little bit further? And I love the analogy that John made about the car just now, because think about cars. We came from a horse and buggy on wheels to the internal combustion engine. Then we got, instead of a carburetor, we got a fuel injector. We've got power steering. Now we've got electric cars. This is an example of engineering making incremental improvements that over time make a big difference. And that's what we're trying to do through the whole investment process, is this whole success-driven model. So the big question that I think every investor has and has had since the dawn of investing is, why suffer in a crash? How can I avoid the pain and uncertainty when the market is in a crisis, right? Whether it's 2008, the dot-com crash, 1987, the 1997 financial crisis, you know, whatever it is, most investors are trying to avoid this. They're trying to figure out a way to avoid the drawdowns in their account when a crisis is occurring. And what's the solution everybody's been given? Buy and hold for the long term, diversify your investments, right? That's the advice that everybody has been given for the last 30, 40 years. So let's gain some perspective on what buy and hold really means. Now, buy and hold, this is a market of the S&P 500. We're using the ETF, the SPY, which is an ETF that tracks the S&P 500. And over the last 16 years, it's produced an average return of 5.25%. Now, the market average over actually 100 years is more closer to 7.17%. But for this purpose, we're going to say 5.25%. But in order to achieve that average return over the last 16 years, you had to sit through two market crashes. Right? The dot-com, where you saw the market go down, I think the S&P was down about 48%. That's this first crash down here. And the financial crash, which took us down even further, that's a 55% drawdown. If you had $100,000 in savings or invested that you were looking and counting on for the future, that turned into $45,000. That's where most people make the mistake. Right? Everybody's buy and hold. They believe in index investing until maybe you get down about 10, 15%, then they start to question it. And you know, a good financial advisor, a good broker say, well, you know, we got to invest for the long term. They might be able to convince you to keep holding for the next maybe down 20%. But when you get down 30, 40, 50%, most humans will kind of go into a preservation mode and they'll just say, sell, get me out. And they sell at the bottom. And they're never really convinced to go and buy back into the market till it's beyond the high. So you're in this perpetual habit of selling low, buying high, selling low, buying high, which is how most investors really shoot themselves in the foot. So this is a model of buying and holding, and it has advantages, but it has some severe drawbacks as well. So now we introduce the bonds. Now this is another ETF, the IEF, which tracks the 10-year US government bond. And you can see that it's actually had pretty good returns over the last 15 years. Of course, we've been in a bond bull market for the last 30 years, with an average return of about 4.5% and a drawdown of 10%. Much, much easier to handle. Now, the only thing with this is that bonds don't go up as much as stocks. We just know that historically speaking, for the last 120 years, bonds just don't perform as good as stocks, or as well, I should say, as stocks. So what a lot of people have done to try and sort of, walk the rope or walk the line between these is they said, let's create a combination of stocks and bonds to try and adjust your risk-adjusted returns. And so this green line is a combination of buy and hold at a ratio of 60% bonds, 40% stocks. This is kind of just the go-to benchmark for people who want to buy and hold. Most advisors or brokers will recommend this sort of a mix, 60% bonds, 40% stocks. And what we see here is that our average return is actually a little bit better, 5 3/10%, and our drawdowns are greatly reduced at only 19%. Most people will have a little bit easier time digesting a 19% drawdown in their account versus 55, obviously. No drawdown is ever fun, but 19% is a little bit easier to handle. This is sort of the investment world's, the current investment world's, this is their current strategy on risk control. This is their proposition on how we can make better risk-adjusted returns for an investor. Now, I look at this and I say, if owning U.S. Treasuries and stocks maintains long-term growth and reduces volatility, the drawdowns, what happens if stocks go down and bonds go down? That could happen. Even though it hasn't happened in the last 16 years, it could happen. Anybody was around during the 60s and the 70s as an investor? Okay, during that time period, we saw rampant inflation, which actually made the stock market go down, but also the inflation made U.S. Treasury yields go up. And we know that yields are inverse to bond prices, so bonds also went down during that time. So to me, owning both U.S. Treasuries and stocks is part of the solution. It opens us up to really big risk if both of those asset classes go down at the same time. So the question that I propose is there a better way? Now, one of the things that I really like about working with John is that we are both looking at different things that can help clients achieve better returns. One of the things that we've observed over time, and if you receive the newsletter that we put out every month, we highlight a relationship between analyst estimates and the S&P 500. Now, this is something we've been watching and really keying in on, because when you overlay analyst estimates and the S&P 500, they actually have a pretty strong correlation in how they move together. Okay? Just for anyone who's not familiar with the analyst estimates, what it is, say you have Apple. You have maybe 20 different analysts from Goldman Sachs, JP Morgan, Morgan Stanley. They're all estimating how much Apple is going to make for a particular quarter or for a particular year based on revenues, new product sales, and basically all these analysts covering one company do the same thing for all 500 companies in the S&P 500. What this red line represents is the aggregate. This is the average total of all the analyst estimates of all 500 of the largest companies in America. So we overlay this and we say, John and I looked at this, we said, there seems to be some kind of a correlation. When estimates go down, basically analysts are estimating or guessing that companies will not make as much money as they did the previous year. When that starts to go down, well, the market goes down. And when the analysts start to look at the numbers and they say, these guys are selling more, they're cost cutting, we're going to raise their estimate. Well, if that happens on the aggregate of all companies in the S&P 500, we tend to notice the market lifts. So we had this idea that we said, well, I wonder if there is some kind of a correlation between analyst estimates and the performance of the market, right? We're just posing a question out there. So what we do is we state a hypothesis. We say, If analysts are raising estimates, we're going to buy or stay invested in the market. And if analysts are lowering estimates, we're going to sell or stay out of the market. Pretty simple hypothesis, right? So here's one of the things we do. We go out and we test this. So there's a lot of coding involved, a lot of stats, a lot of math. But basically, we plug this back into our testing software to see if there is some real correlation between these two things. And here's the result. Not too good. Average return is actually less than the market from a buy and hold standpoint, even though we've reduced. That's no good. But let's try it from a different angle, right? We can try different angles, and we now have the technology, the knowledge base, and the computer power to go and test these things. So we say, okay, what if we modify our hypothesis just a tad? If the analysts are raising estimates and the markets are going up, meaning that buyers are still buying the market, then we buy. If analysts are lowering estimates and the prices start to fall, then we're going to sell or stay out of the market. So we run that through our testing, more math, more stats, more computer programming, and here's the end result. Now that's pretty cool. We've been able to basically double over the last 16 years the average return, or the annualized return I should say, and look at the drawdown. We've reduced the drawdown to only 18%. Now remember, buy and holding of a bond and stock mix was a 5%, 5.25% return with about a 19% drawdown. What we did is we were able to maintain the drawdown at about 19% off the high at any given point in time, but we're able to improve our annualized returns. Now this is a process that we're working with, right? This is one of the things that we do at JCN. So this is kind of our eureka moment. John and I looked at each other and said, I think we're onto something here. I think there is a better solution to what people are currently doing. We've kind of just touched the ice, or touched the tip of the iceberg of one of the things we can do to help people avoid big drawdowns while still maintaining good returns in their portfolio. However, John's famous saying, if a little's good, a lot's better. Well, we can always improve it and make it better. So now the hypothesis, or the idea goes, well, how can we improve on the returns from a risk-adjusted basis? My thought process was, what if you owned bonds during the periods where the market wasn't doing well, and then switch it back into stocks when the markets were doing well again? Could this increase our performance? So we ran this through our testing process, and we basically showed that, there's not a whole lot of extra return from an average annualized return. 9.75 a year versus 9.59 per year. It's not a whole lot. The drawdowns weren't any different either. However, what I want you to notice is during the period where we would have been sitting in cash, you see how you make just a little bit extra money? So here's where just my background as a trader comes into play. I know that if I stay out of the market, I actually kind of lose the engagement factor, and I don't really care about the market as much. And it's hard to know when to get back in if you've been in cash for a year and a half. So what we did here is we said, okay, even though it doesn't add any significant incremental improvement on our returns, what it does do is, from a psychological standpoint, it helps to keep us engaged in the process, right? If most investors will sell when they're down 40 or 50%, a lot of other investors might completely bail on the process if they haven't made money for the last year and a half, right? You kind of just get bored, stir crazy. So this helps us to stay engaged with the market, which helps us to stay engaged with the overall process of managing our portfolio. But this, in essence, is what we're doing here. Is we're taking different scenarios, we're running it through our processors and our programs, and we're coming up with quantifiable results that either show that what we saw or what we thought might give us an edge actually gives us an edge, or it doesn't. Okay? Any questions on this so far? No questions. All right. Asset management, and actually tactical asset allocation, or TAA, is in essence what we're doing. It's trying to figure out when to be in the market and when to be out of the market. That's what that fancy word means. Tactical just means we're in or out of the market. Now the critique that most buy and hold investors have of switching in and out of the markets is, what happens if your indicators fail? What happens if all of a sudden your indicators say to sell, you sell, and the market rips the other way? Fair enough. And I completely agree with that point. A lot of systems out there, this has happened to them. Especially in the last 2 or 3 years, you've read stories about how mass outflows of money are coming out of hedge funds. That's because hedge funds have done extremely well for the last 10, 15 years, and over the last 2 or 3 years, they've lost a lot of money. So people are just exiting en masse, and that's because all of a sudden their systems aren't working the way they were designed. And that's the big, I think, critique of what we're doing is, what happens if it fails? So I say, well, if a screwdriver is pretty good at fixing the majority of issues, but it can't address other issues, well, why not add a couple other things, maybe a socket wrench? If you have redundancies or fail-safes, this is something that we do in engineering. We make sure that if something that's critical to the process fails, that we're not stuck, with a flat tire on the road. We can still get to our destination. And think about, just with the car analogy, if you got a flat tire previously, you have to go out, get out in traffic, be in a dangerous spot to fix your tire. Well, engineers have figured out a way to create run-flat tires that can take you another 55 miles so that you can get to a safe spot to change your tire. That's essentially what we're doing, is we're designing run-flat tires for investing. Fail-safes that help you get to where you need to go, even if part of the process doesn't work as well as it should, okay? So this is where I ask the question, well, is there a way that we can create a different system that's not based on the mechanics of the previous system that can still give us an investable edge? And this is using something very simple. A lot of people have talked about this. It's been studied in the academic circles in finance, but it's just using a moving average crossover. What a moving average crossover, or what a moving average I should say, is just the historical price over time. So the most classic one you'll see is like the 50-day moving average, the prices over the last 50 days. Another classic one is 200-day moving average. And essentially it's when the faster moving average crosses over the slower moving average, it signals a buy. And on the opposing side, if it crosses down below it, just signifies a sell. It's very simple. And it's purely mechanical. It doesn't rely on analyst estimates at all. So we came up and we actually tested a lot of different scenarios, and we actually found, okay, so these are our current scenarios now, we actually found using a purely mechanical process to be in and out of the market produced about the same drawdowns, but almost a full percentage point per year of annualized return, better returns. That's kind of neat. What this is telling me is we have two different processes in place that are completely independent of each other, that are producing about the same returns that we'd like to get. So what that has is, that's given us is a way to kind of feel a little bit safer that if one fails, the other is going to be able to maneuver and get us to where we need to go. And this is really, I think this is part of the whole redundancy process that we're looking for. So, critique. What if both fail? And that's a very fair question. What if they both don't give us the signal that we needed to be in or out of the market? It could happen. Well, again, if a little's good, a lot's better. If you can't solve the problem with a screwdriver and a socket wrench, maybe a hammer and a saw might get you there. However, this is where a good engineer is going to ask the question. Before we go out and start putting all these different widgets and gadgets onto what we're trying to do, are we creating a situation of over-designing, right? Over-designing is essentially adding a whole bunch of stuff to the end process that doesn't need to be there, okay? And really this is a bad thing to happen because, let's use the car analogy, right? You could put 4 extra spare tires in the car, and you would never have a flat tire, right? But all that added weight would reduce your miles per gallon. It would reduce the amount of, or increase the amount of weight in your car, right? You wouldn't have as much passenger space. So there's always in engineering this give and take. we want to have some fail-safes, but we don't want to have an over-design where it actually impacts what we're trying to achieve. So this is a very important thing that we have to guard against as we're going through this whole process, right? So we don't want to add just to add. We want to add to make sure it actually benefits our end goal. Remember way back in the day, some people theorized that you could mix different assets in a buy and hold? Well, buying and holding is a system if you have a significant time horizon. Buying and holding works if you have a 100-year time horizon. The nice thing about buying and holding is there is no whipsaw, there is no in and out of the market, you're just always invested, right? Now the bad side is the drawdown. So what I kind of asked myself is, what if we took the best parts of buy and hold, and what if we combined it with some of the best parts of our tactical asset management? We combined the two scenarios and created a non-correlated system of all three strategies, okay? So remember that we could have created a whole new tactical asset management system and had three of them. But what I said is, you know, buying and holding, there are some merits to it. And what happens if we combine all three of them? Well, here's the buying and holding. You know, these are like bonds. These are the mix of bonds, and then the S&P just buying and holding. If we take our analyst estimates and our moving average crossover and combine it with equal proportions with a buy and hold, we can actually achieve an annualized return of about 8.25% with a max drawdown of just 11%. Now for most people, 11% is much easier to live with than a 19% drawdown, yes? And the best part about what we're doing is remember that our first two strategies, our analyst estimates and our moving average crossovers, moved us into bonds when the environment wasn't favorable for stocks. Now there's a portion of our portfolio in this model, this combo 3, that is just continually invested in bonds and stocks. So what that means is, during periods of uncertainty, this combination of different systems automatically reallocates you to more bonds. It's not based on your age, it's based on market condition. So if you're ready to retire, you know, if you put all your money, or I should say 80% of your money in bonds, and the bond market tanks as interest rates go up, that's not a good situation for a retiree. But what we're saying is, hey, if you do a system that kind of is able to thread the needle, so to speak, you can be in a situation where you're a retiree, bonds are selling off, but only a quarter of your portfolio is in bonds. The rest is in S&P 500 ETF, which is going up. And that's what we're trying to do, is we're trying to create a system that automatically, incrementally moves us away from risk or back into risk when the system tells us to do that. That's essentially what we're doing. And this is actually pretty cool. But I said if a little's good, a lot's better. What happens if instead of the S&P 500, we use something that a lot of people have come to trust and respect over the years, which is the Vanguard Total Stock Market Index. Now, what the Vanguard Total Stock Market Index is it's pretty much, I think, 99.7% of the investable world of the stock market. So instead of only the largest 500 in market cap, this includes some of the smaller market cap stocks that can make some pretty significant gains. Historically, what we've seen is that the ticker VTI, the Vanguard Market Index, can usually outperform the S&P 500 by about 1 or 2 percentage points per year. That's just averaged out over the last 20 or 30 years that Vanguard has had their stock market index. So what we see here is, if we use the Vanguard ETF in place of the SPY, which is the S&P 500 index, we can achieve an annualized return about a full percentage point higher than the S&P 500 with no significant increase in your max drawdown scenario. This 12% and 13% represents the max drawdown. This is the worst case scenario. But in exchange for a little bit extra worst case scenario, we make about a full percentage point more per year on average. That's an annualized return. This is the process that we go through, right? And this is why I think what we do here is very different compared with most other advisors or brokers or financial analysts. What we feel is we can do better with some of our processes, but we don't want to open ourselves up to the full risk of if they fail. So we're combining both of these together to come up with a solution that might be more suitable for a larger portion of investors. Any questions on this?
Why not shorting some of those during the downturn?
That's a great question. Why not shorting it during the down periods? One of the things we found, and this is something that I'm still toying with, is when you short, if the market rallies the other way, the shorts go down, right? And there's a different sort of, it's a different risk profile when you do that, because when you short it, you can achieve a little bit extra return, but the drawdown actually increases because of the nature of how the short instrument works. So the short instrument basically moves inverse to the market. It's a complete inverse correlation. But that drawdown now it drags the performance down overall. So it's something I'm toying with. And in fact, there's another portion of what I'm studying, which is volatility. So there are instruments that increase in price when volatility increases. Has anyone heard of the VIX? The VIX index? The VIX index is basically, it's like an insurance, the cost of insurance for options on the S&P 500. And essentially, when the markets get bad, people want insurance against the market. They buy put options. And this VIX rises when a lot of people buy put options. So it's an instrument that can rise in volatile times. But those are two things that I'm actually exploring at the moment to see if we can come up with a little bit better solution than what we have here. This is pretty good. But you know me. I think we can always do better. But that's a great question. I think you had a question here? Yeah.
Well, the Vanguard gives you the best returns.
Yes.
Where do you fall in that? Which colored line are you in?
Well, actually, the green one, the regular Vanguard would actually track about what the S&P 500 did. So it would probably be about here, with the similar drawdown characteristics. What we did is, in our system of 3 different strategies, we substituted the Vanguard index instead of the S&P 500 index, which gives us an incremental return, extra return in here. So we're not, this is not the Vanguard index. This is using the Vanguard index in place of the S&P 500 to get just a little extra return.
Okay, so your performance is the green line then?
That's correct, yes. And I just want to make it very clear that these are, what's the best way to say it? These are back-tested results. These are simulated. This is not something that we've done in real time. All right? But these are back-tested using all the available data that we have. So this is very accurate data. But that has to be made very clear that this is a scenario that we're studying, and what hopefully I think you'll see is that we've tried to design different fail-safes in case a system doesn't perform the way we thought it should have. The worst thing you can do is design a system that looks great in hindsight but doesn't perform going forward. So what we're doing here is we're saying, okay, we know there is a risk to that outcome, so here are some of the fail-safes that we put in place to avoid against that. Any other questions? Yes?
Does that strategy you described also include the moving average crossover?
That is correct, yes. So this first one, this combo 3, has all 3. This is using that analyst estimates that we discovered. It's using the moving average crossover, and it's using buy and hold. So it's using equal portions of all 3, and all we did is we substituted the Vanguard index for the green line, and that gave us just a little extra oomph in performance, if that's something that somebody wanted. So what we're looking at here is a comparison, and I wanted to break this down because it's important to know the pros and cons of each approach. The analyst estimates that we were looking at had great returns, had okay max drawdowns, but the whipsaws, there are some ins and outs, so you could get whipsawed. Emotional highs and lows, it's a little bit better because you're not going from such a high to such a low. But the history, we've only got 15 years. That's all the data we have. So there is a possibility that maybe, we're only looking at the best 15 years. So this is kind of a drawback in my opinion. There's not a lot of history. Moving averages, great returns, okay drawdowns, okay, there are some ins and outs. Emotional highs and lows are good. This one has a little bit better history rating because this system that we tested has been studied by other academics, I think back to the 1960s on the S&P. So there is a significant amount of data to show that this has a good investable edge. Now buy and hold, annual returns are okay if you mix stocks and bonds, but the max drawdowns, they're brutal, 55% down from the top to bottom. Whipsaw, well, there is none, so that's a good thing about buy and hold. But emotional highs and lows, working at MarketSmith, I remember fielding calls from individual investors during 2008. You can hear on the phone their desperation. They don't know which way is up. You can hear it in their voice and how they're making decisions and how they become disenchanted with investing in the stock market. And that's the drawback to buy and hold, is that in a crisis situation, everybody panics, right? So what we're trying to do is we're trying to reduce this. But the benefit to buy and hold is we have over 120 years of data of what the stock market's going to do. But I want to put a caveat in that. Buy and hold is a system. We know what it's done for the last 120 years. Question to everybody. Is that going to be your typical return for the next 120 years? We don't know. We've seen we've seen a really good period, I should say, of America. Does that mean that that same level of growth is going to apply for the next 120 years? We don't know. We don't know. It could be greater, it could be worse, it could be the same. All of these have the same drawback at the end. We don't know what the market's going to do tomorrow. We only can study what it's done in the past. But what all three, or at least these two, can do for us, the analyst estimates and the moving average, they give us a way to get out of the market when we don't know which way is up. They give us an exit strategy. And the buying and holding, well, that gives us the ability to not fully be out of the market in case one of the other systems doesn't work the way we are expecting. So net effect is, by using all three of these together in combination with the Vanguard Total Stock Market Index, we've really solved the solution of annual returns. 10% annual returns, by the way, is pretty good numbers compared with 5.5. Max drawdowns, we've shown we've significantly improved the max drawdowns. Whipsaw, because we're never fully out of the market or fully into the market, three different systems are giving you three different buys or sells. The whipsaws are much more manageable because you're not fully out of the market when the market goes up, and you're not completely invested in the market when the market falls down. You're going to have varying degrees of percentage invested in each asset. Emotional highs and lows, well, this kind of, if you have good returns and you don't have a lot of drawdowns, well, you're going to have good emotional highs and lows, right? And the history is now we've blended something that doesn't have a lot of history, something that has a ton of history, and something in the middle. And we basically said, you know what? There's a reasonable expectation that we've done our due diligence in terms of looking at different historical lengths to come up with something that we have some measure of expectancy should work going forward. Right, so this is, by combining all three of these, the best part of, really, best of all universes. And here's the thing I like the best about this. We're not buying or selling 15 different ETFs or stocks. This is just the Vanguard Total Market Index and the IEF, the 10-year bond. We just invested at varying degrees of those two ETFs. So when you look at your portfolio, it's a lot easier to make sense of it. You've got two holdings. So this is part of the whole process that we're doing. And in the end, when you look at success versus mediocrity or failure, the whole process in what we're involved in, it's not hard to achieve the success we want. It just takes creative thought. Remember, at the very beginning of the presentation, I said we're about thinking different. We don't want to follow the herd. We want to have creative thought. And we have to put in a little bit of work. I know math and stats aren't the funnest for everybody, but it's how we get to the end point. This is how we achieve different results for the clients at JCN. And ladies and gentlemen, thank you for the presentation today. I'll stick around for any